What if I told you that the greatest economic collapse in modern history didn't actually begin with a market crash? What if the real disaster of 1929 started months earlier, quietly, invisibly inside a financial system that looked almost unstoppable? And here's the unsettling part. Many of those same warning signs are flashing again today. We're told, don't worry, things are different now. Stronger regulations, faster technology, smarter central banks. But history has a strange way of repeating itself, especially when no one expects it. Today, we're going back almost a century to uncover the hidden mechanics that triggered the 1929 crash, and to ask the question no one wants to confront. Are we walking down the same path again? Stay with this story till the end, because the parallels are more shocking than you think, setting the stage background and teasing twists. To understand how the world fell apart in 1929, you need to meet three characters. 1. A booming economy fueled by innovation: cars, radios, electrification. 2. A generation of new investors who believed markets could only go up. 3. A fragile financial system built on loans, leverage, and illusions. Sound familiar already? But here's the twist. The real danger wasn't greed or speculation. It was something deeper, structural, something quietly engineered into the global economy. And that same structure still exists today. But we'll get there soon. First, let's go back to where the disaster began. The origins, cause, and effect begins the Roaring '20s. When nothing could go wrong, the 1920s were explosive. Industrial output doubled. Car ownership skyrocketed. Radio transformed communication. Consumer credit went mainstream. The world believed a new era of prosperity had arrived, permanent, unstoppable prosperity. Newspapers claimed the stock market had reached a permanently high plateau. Banks encouraged ordinary citizens to buy stocks on margin. Buy now, pay later, get rich forever. The cause was simple: confidence. The effect was dangerous overconfidence. Investors didn't just buy stocks, they borrowed money to buy more stocks. Some brokers allowed 90% leverage. Imagine buying a $100 stock for only $10 of your own money. You can see where this is going. But the real crack in the foundation wasn't leverage. It was liquidity. A system that needs constant new money dies the moment that money slows down. And by late 1928, something did slow down. The rise, why the bubble grew, a market built on hype and hope. From 1927 to 1929, the Dow Jones more than doubled. Companies with no profits saw soaring valuations. Americans rushed to open brokerage accounts, many for the first time. But behind the scenes, banks were quietly getting nervous. The Federal Reserve noticed the speculation and tried to cool it by raising interest rates. This made borrowing more expensive. Margin loans became riskier. Investors had less new cash to pump into the bubble. And here's the cause and effect chain that few noticed. Higher interest rates gives less borrowing, gives fewer new investors entering slower market growth, rising fear, and then panic. The system didn't collapse instantly. It cracked first, silently. Today's economy has cracks too. But patience. We'll get to that. The breaking point, the crash itself, October 24, 1929. Black Thursday, it began with whispers. Prices dipped, investors sold. Margin calls triggered forced selling. Then came the tipping point. There were more sellers than buyers. When a leveraged system loses buyers, it collapses in seconds. By the morning of October 24th, crowds gathered outside the New York Stock Exchange. Phones rang non-stop. Brokers screamed. Prices plunged. Bankers tried to stop the fall by injecting millions into the market. It bought them a few hours, but the panic was already alive. October 28th and 29th, Black Monday and Black Tuesday, finished the destruction. The Dow fell 25% in 2 days. Factories closed. Banks collapsed. Unemployment skyrocketed. But the stock market crash wasn't the real disaster. It was only the beginning. The fallout depression and failed fixes, a system frozen solid as stocks fell. Margin loans came due. Investors couldn't pay. Banks collapsed under the weight of bad debt. Then came the next cause-effect chain. Bank failures. Less lending, less business activity. More layoffs, less spending, more failures. A vicious loop. Government responses were slow, fragmented, and often wrong. They raised taxes, cut spending, reduced the money supply. Everything that could make the crisis worse, they did. By 1933, almost 9,000 banks had failed. Unemployment hit 25%. Global trade collapsed by 66%. And here's the twist most people don't know. The Depression didn't end because the economy healed. It ended because World War II forced governments to spend again. In short, the fix wasn't economic. It was geopolitical. Modern parallels. Are we repeating history? Now let's fast forward to today, because the patterns are disturbingly familiar. 1. Record debt and leverage in 1929. Margin debt exploded. Today, global debt has crossed $315 trillion, the highest in history. Households, corporations, even governments are leveraged to the edge. 2. Asset bubbles everywhere in the 1920s. Stocks were the bubble. Today, stocks, real estate, crypto tech valuations, government bonds, everything has inflated at once. 3. Overconfidence in new technology. 1920s. Radio, automobiles, electricity. Today, AI, fintech, automation. Both IRAs believed technology eliminated risk. Both were wrong. 4. Rising interest rates after long easy money. This one is almost identical. The Fed kept rates near 0.4 over a decade, then suddenly raised them fast. What did this trigger? Bank failures, housing, market pressure, credit tightening, falling liquidity, exactly what triggered early cracks in 1928. 5. The liquidity problem. In 1929, liquidity dried up in days. Today, markets rely on constant liquidity from central banks. Remove it, and the machine seizes. 6. The mystery nobody mentions. The greatest similarity isn't debt or bubbles. It's the belief that today's system is too advanced to collapse. People believed the same thing in 1929. History didn't care. Conclusion, takeaways, plus warning, plus call to action. 3 takeaways. Takeaway 1. Crashes don't start with panic. They start with confidence. Overconfidence hides risks until it's too late. Takeaway 2. Leverage accelerates destruction. When systems rely on debt, even small shocks create big explosions. Takeaway 3. History repeats when we ignore its patterns. The signs of 1929 are not ancient, they're present, right now. A final warning. Today's economy is not guaranteed to collapse, but it is guaranteed to react to the same forces that triggered past crises: rising interest rates, falling liquidity, unsustainable debt, blind optimism. The question isn't, will we repeat 1929? The real question is, are we preparing for what happens if we do? If you found this breakdown eye-opening, don't forget to like, subscribe, and share this video. More deep dive financial history is on the way, because the future makes more sense when we understand the past. And, as always, stay curious, stay informed, and I'll see you in the next one.